Slide 1. The role of investors. This slide introduces investors as one of the primary audiences and driving forces behind the TCFD framework. Explain that institutional investors, asset managers, pension funds, sovereign wealth funds, and shareholders increasingly recognize climate change as a material financial risk capable of influencing long-term portfolio performance, corporate valuation, and market stability. Prior to TCFD, investors often lacked reliable, comparable, and financially relevant climate-related information necessary for informed investment analysis. Discuss how TCFD-aligned disclosure enables investors to better evaluate climate-related risks and opportunities across sectors and geographies. Investors can assess transition exposure, physical climate vulnerability, emissions intensity, governance quality, and strategic resilience under different climate scenarios. These insights support improved portfolio management, long-term capital allocation, and risk-adjusted investment decision-making. Highlight that investors also play an important stewardship role. Through shareholder engagement, proxy voting, and strategic dialogue, investors increasingly encourage corporations to strengthen climate governance, improve disclosure quality, and adopt credible transition strategies aligned with long-term sustainability objectives. Explain that climate-related disclosure is essential for preserving fiduciary responsibility. Long-term institutional investors must evaluate how climate change may affect infrastructure systems, financial markets, operational continuity, regulatory environments, and future economic conditions. Discuss how large institutional investors such as BlackRock, State Street, Norges Bank Investment Management, and global pension funds publicly supported the TCFD framework because it improved market transparency and enhanced confidence in financial reporting systems. Emphasize that the TCFD fundamentally changed the relationship between investors and corporate climate governance by establishing climate disclosure as a mainstream financial reporting expectation rather than merely a sustainability initiative. Investors increasingly view climate resilience as a core indicator of long-term enterprise value and strategic preparedness. Slide 2. Lenders and insurance underwriters. This slide explains the critical role of lenders and insurance underwriters within climate-related financial governance. Discuss how banks, financial institutions, insurers, and underwriters increasingly recognize climate change as a material source of credit risk, operational disruption, asset impairment, and long-term financial instability. Explain that lenders require climate-related information to assess the creditworthiness of borrowers and the long-term viability of financed projects. Climate-related disclosure helps banks evaluate whether organizations possess resilient business models, credible transition strategies, and adequate governance systems capable of managing evolving climate risks. Highlight that physical climate risks such as floods, hurricanes, heat waves, and wildfires can directly affect asset values, infrastructure durability, operational continuity, and repayment capacity. Transition risks arising from carbon pricing, emissions regulation, technological disruption, and changing market preferences may also affect borrower resilience and financial performance. Discuss the role of insurance underwriters. Insurers increasingly rely on climate risk analysis to determine policy pricing, underwriting exposure, reinsurance structures, and long-term insurability of assets and operations. As climate-related losses continue rising globally, insurers must better understand physical and transition risks affecting industries, infrastructure systems, agriculture, transportation, and real estate. Explain that TCFD-aligned disclosures improve the ability of lenders and insurers to incorporate climate considerations into mainstream financial analysis, credit evaluation, and risk management systems. Highlight that inadequate climate risk disclosure may lead to mispricing of risk, capital misallocation, and increased systemic financial vulnerability. Emphasize that the banking and insurance sectors became among the strongest institutional supporters of the TCFD framework because transparent climate disclosure strengthens financial resilience, improves market confidence, and supports more sustainable capital allocation practices across the global economy. Slide 3. Steady progress in disclosure rates. This slide highlights the steady global improvement in TCFD-aligned disclosure practices across industries and geographies since 2017. Explain that each successive TCFD status report documented increasing rates of corporate climate-related disclosure, demonstrating the growing institutional acceptance of climate governance as a mainstream financial reporting requirement. Discuss how organizations progressively strengthened board oversight, strategic climate integration, emissions reporting, risk management systems, and climate scenario analysis capabilities. Investors and regulators increasingly expected more transparent, comparable, and decision-useful climate disclosures capable of supporting long-term financial analysis. Highlight that the 2022 status report confirmed consistent year-over-year improvement in disclosure quality and participation rates across sectors such as banking, insurance, energy, manufacturing, transportation, infrastructure, and technology. Explain that regulatory developments significantly accelerated disclosure growth. Jurisdictions including the United Kingdom, New Zealand, the European Union, Japan, Singapore, and others introduced or proposed mandatory climate-related disclosure requirements aligned with TCFD recommendations. Discuss how disclosure progress also reflected broader societal and market expectations regarding sustainability, accountability, responsible governance, and long-term resilience. However, explain that challenges remained regarding financial impact quantification, Scope 3 emissions disclosure, and sophisticated scenario analysis methodologies. Many organizations continued improving their technical capabilities and governance maturity. Highlight that the annual TCFD status report served as important accountability mechanisms by benchmarking disclosure trends and encouraging continuous improvement across global markets. Emphasize that the steady increase in TCFD-aligned disclosure practices validated the effectiveness of the framework in transforming climate reporting from a voluntary sustainability exercise into a mainstream financial governance expectation integrated within corporate reporting systems worldwide. Slide 4. TCFD and the Paris Agreement. This slide explains the close alignment between the TCFD framework and the goals of the Paris Agreement adopted under the United Nations Framework Convention on Climate Change in 2015. Explain that while the Paris Agreement established global climate objectives, the TCFD translated those ambitions into practical financial and corporate disclosure mechanisms. Discuss the primary objective of the Paris Agreement, limiting global temperature rise to well below 2 degrees Celsius above pre-industrial levels while pursuing efforts to limit warming to 1.5 degrees Celsius. Achieving these goals requires substantial transformation across energy systems, transportation, manufacturing, infrastructure, agriculture, and financial markets. Explain that the TCFD encouraged organizations to assess resilience under 2 degrees Celsius or lower climate scenarios aligned with Paris Agreement pathways. This represented one of the framework's most transformative innovations because companies were required to evaluate long-term strategic resilience under multiple future climate conditions. Highlight that climate scenario analysis helped organizations understand potential policy changes, technological disruption, market transitions, physical climate impacts, and operational vulnerabilities associated with global decarbonization. Discuss how TCFD disclosures also supported investors, lenders, insurers, and regulators in evaluating whether organizations were prepared for transition toward a lower carbon economy. Explain that the framework helped connect climate science, public policy, and financial governance within a unified disclosure architecture understood by capital markets and corporate leadership. Emphasize that the TCFD effectively operationalized the financial dimensions of the Paris Agreement by integrating climate transition considerations into mainstream strategic planning, enterprise risk management, and corporate reporting systems. Conclude by explaining that the alignment between TCFD and the Paris Agreement significantly accelerated global climate governance integration and strengthened the role of financial markets in supporting sustainable economic transition. Slide 5. The TCFD Knowledge Hub. This slide introduces the TCFD Knowledge Hub, launched in May 2018 in collaboration with the Climate Disclosure Standards Board, CDSB. Explain that as adoption of the TCFD framework accelerated globally, many organizations required practical implementation support, technical guidance, and educational resources. Discuss the purpose of the Knowledge Hub as a centralized platform providing tools, case studies, disclosure examples, webinars, sector-specific guidance, and technical implementation resources. The hub became an important institutional mechanism supporting organizations seeking to operationalize TCFD recommendations effectively. Highlight that many companies initially struggled with climate scenario analysis, emissions accounting, governance integration, transition planning, and climate risk quantification because these disciplines required new technical capabilities and interdisciplinary expertise. Explain that the collaboration with CDSB strengthened the technical rigor, accessibility, and credibility of the platform. The Knowledge Hub helped organizations improve consistency, comparability, and disclosure quality across industries and jurisdictions. Discuss how the hub supported organizations worldwide, including corporations in emerging markets and smaller entities with limited climate governance expertise. Highlight that implementation guidance became increasingly important as regulators and investors demanded more sophisticated, financially integrated climate disclosures. Explain that the Knowledge Hub also encouraged institutional learning and dissemination of best practices by showcasing real-world examples of TCFD-aligned reporting and governance systems. Emphasize that the TCFD Knowledge Hub significantly accelerated global adoption of climate-related disclosure practices by transforming the framework from a conceptual reporting model into a practical and operationally achievable governance system for organizations worldwide. Slide 6. TCFD's influence on global standards. This slide demonstrates the extraordinary influence of the TCFD framework on global sustainability reporting standards, financial regulation, and climate governance systems. Explain that the TCFD became the conceptual foundation for multiple international disclosure frameworks and regulatory initiatives worldwide. Discuss how organizations such as the International Sustainability Standards Board, ISSB, European Financial Reporting Advisory Group, EFRAG, Network for Greening the Financial System, NGFS, and G20 frameworks incorporated TCFD principles into their governance and disclosure architectures. Highlight that the ISSB's climate standards, particularly IFRS 2, directly adopted the TCFD's four-pillar structure: governance, strategy, risk management, and metrics and targets. This integration institutionalized TCFD principles within mainstream international financial reporting systems. Explain how EFRAG's European Sustainability Reporting Standards, ESRS, also incorporated climate governance and disclosure principles aligned with TCFD recommendations. Discuss the influence of TCFD on national regulatory systems across the United Kingdom, Japan, Singapore, New Zealand, and other jurisdictions introducing mandatory climate-related disclosure requirements. Highlight that TCFD successfully created a globally recognized disclosure language connecting climate science with financial analysis and investment decision-making. Explain that the framework's widespread institutional influence significantly improved comparability, consistency, and transparency across climate-related reporting systems globally. Emphasize that the TCFD became one of the most influential sustainability governance frameworks ever developed because it bridged the gap between environmental sustainability and mainstream financial governance. Conclude by explaining that the framework's integration into global reporting standards ensures its enduring influence on corporate disclosure, investment analysis, and financial regulation for decades to come. Slide 7. Transition to a lower carbon economy. This slide discusses one of the central themes of the TCFD framework, the global transition toward a lower carbon economy. Explain that the TCFD recognized this transition as both a major source of financial risk and a significant generator of strategic opportunity. Discuss transition risks first. Organizations may face policy changes, carbon pricing, emissions regulation, technological disruption, changing customer preferences, litigation exposure, and reputational pressures associated with decarbonization. Carbon-intensive sectors such as fossil fuels, mining, utilities, transportation, and heavy manufacturing are particularly exposed to transition-related financial impacts. Highlight that poorly managed transition risks may lead to stranded assets, declining competitiveness, reduced market value, operational disruption, and investor concern. However, explain that the lower carbon transition also creates substantial economic opportunities. Companies investing in renewable energy, low carbon technologies, sustainable infrastructure, energy efficiency, climate adaptation, and green innovation may benefit from emerging markets and long-term growth potential. Discuss how proactive organizations integrating climate considerations into strategic planning and governance systems are likely to demonstrate stronger resilience and adaptability under evolving market conditions. Explain that the TCFD framework encouraged organizations to assess strategic resilience under multiple climate pathways, including orderly and disorderly transition scenarios. Highlight that climate-related financial disclosure supports investors and stakeholders in evaluating organizational preparedness for long-term economic transformation. Emphasize that the transition toward a lower carbon economy represents one of the most significant structural changes in modern economic history, reshaping industries, investment flows, supply chains, and global financial systems. Conclude by explaining that the TCFD framework helped organizations and financial markets navigate this transition through transparent, forward-looking, and financially integrated climate-related disclosure practices. Slide 8. Climate Opportunities. This slide focuses on the opportunities created by climate transition and sustainable economic transformation. Explain that the TCFD framework not only addressed climate-related risks but also emphasized the substantial business opportunities associated with sustainability innovation, decarbonization, and resilience building. Discuss the first category, resource efficiency. Organizations improving energy efficiency, water management, waste reduction, and sustainable resource utilization can lower operational costs, improve productivity, and strengthen long-term resilience. Efficient resource management also reduces exposure to energy price volatility and regulatory pressure. Highlight the second category, development of new products and services. The transition toward a lower carbon economy creates growing demand for renewable energy technologies, electric mobility, sustainable infrastructure, green construction materials, climate adaptation services, and low-carbon consumer products. Explain that innovation in climate solutions may generate new revenue streams, enhance market competitiveness, and strengthen long-term enterprise value. Discuss the third category, access to new markets and customers. As global demand for sustainable products and responsible corporate practices increases, organizations capable of delivering climate-conscious solutions gain competitive advantages within evolving consumer and investor markets. Highlight that climate opportunities also attract sustainable finance, green investment, and institutional investor interest. Explain that organizations proactively capitalizing on climate opportunities are often better positioned to adapt to regulatory change, technological transformation, and shifting societal expectations. Emphasize that TCFD encouraged organizations to disclose both climate-related risks and opportunities because long-term resilience depends not only on risk mitigation but also on strategic adaptation and innovation. Conclude by explaining that climate-related opportunities increasingly represent important drivers of future economic growth, competitiveness, and sustainable enterprise development across global industries and markets. Slide 9. Widespread adoption, the key to success. This slide explains why widespread adoption was essential for the success of the TCFD framework. Discuss how the framework consistently emphasized that its value depended not merely on participation by a few leading corporations but on broad, consistent implementation across industries, financial markets, and jurisdictions globally. Explain that climate-related financial disclosure becomes most effective when organizations across sectors adopt common governance principles, reporting structures, and disclosure methodologies. Widespread adoption improves comparability, transparency, and consistency for investors, lenders, insurers, regulators, and other market participants. Highlight that broad implementation helps integrate climate-related risks and opportunities into mainstream corporate strategy, enterprise risk management, and financial decision-making processes. Discuss how widespread adoption also reduces systemic financial vulnerability by improving market understanding of climate-related exposures and transition risks. Explain that TCFD's influence expanded rapidly because regulators, investors, financial institutions, and multinational corporations increasingly aligned around a common disclosure architecture. Highlight that international organizations such as the G7, G20, ISSB, NGFS, and regional regulators reinforced adoption momentum by integrating TCFD principles into policy frameworks and sustainability standards. Discuss how network effects strengthened institutional acceptance. As more organizations adopted TCFD recommendations, climate-related disclosure became increasingly normalized within financial markets. Emphasize that widespread adoption transformed climate disclosure from a voluntary sustainability initiative into a mainstream governance expectation embedded within global financial systems. Conclude by explaining that the TCFD's extraordinary global influence resulted largely from its ability to create a shared language connecting climate science, corporate governance, financial reporting, and investment analysis across diverse markets and sectors worldwide. Slide 10. 8 Years of Transformation. This slide presents a timeline summarizing the major milestones achieved during the TCFD's 8-year institutional journey between 2015 and 2023. Explain that the framework evolved from a relatively specialized financial initiative into one of the world's most influential sustainability governance systems. Discuss the major milestones chronologically. In 2015, the Financial Stability Board established the TCFD under the leadership of Mark Carney to improve climate-related financial disclosure and market transparency. In 2017, the TCFD released its final recommendations structured around the 4 foundational pillars: governance, strategy, risk management, and metrics and targets. More than 100 sources publicly supported the framework. Highlight that by 2020, the framework had surpassed 1,000 supporters globally, demonstrating growing institutional acceptance. Discuss the major developments of 2021, including support from the G7 and G20 and the formation of the International Sustainability Standards Board, ISSB, which incorporated TCFD principles into global sustainability reporting standards. Explain that by 2022, the framework exceeded 4,000 supporters while ISSB and EFRAG advanced climate disclosure standards aligned with TCFD recommendations. Finally, in 2023, the TCFD published its final report and formally fulfilled its remit, transferring responsibility to the IFRS Foundation and ISSB. Emphasize that these 8 years fundamentally transformed climate-related financial governance, corporate reporting, sustainable finance, and investor expectations globally. Slide 11. What comes next? This slide discusses the institutional transition following the conclusion of the TCFD's formal mandate. Explain that the work of the TCFD did not end in 2023. Rather, it became institutionalized within the permanent architecture of global financial regulation and sustainability reporting. Discuss the role of the IFRS Foundation, which assumed responsibility for monitoring climate-related disclosures on behalf of the Financial Stability Board. This ensured continuity, consistency, and long-term governance of sustainability reporting systems. Highlight that the International Sustainability Standards Board, ISSB, became the primary institutional successor to the TCFD framework. The ISSB's climate disclosure standards, particularly IFRS S2, were built directly upon TCFD recommendations and the four foundational disclosure pillars. Explain that this transition significantly strengthened global harmonization of sustainability reporting by integrating climate disclosure within mainstream international accounting and financial reporting systems. Discuss how the ISSB standards now serve as a global baseline for both mandatory and voluntary climate-related reporting across jurisdictions and industries. Highlight that the institutionalization of TCFD principles also addressed concerns regarding fragmentation among sustainability frameworks globally. Explain that regulators, investors, corporations, and financial institutions increasingly rely upon ISSB standards to support consistent climate-related disclosure and governance practices. Emphasize that the transition from TCFD to ISSB represents the maturation of climate-related financial disclosure from a voluntary initiative into a permanent component of global financial governance. Conclude by explaining that the TCFD's legacy continues through international sustainability standards shaping the future of corporate reporting, investment analysis, and climate risk management worldwide. Slide 12. The TCFD's enduring legacy. This slide summarizes the long-term institutional legacy of the TCFD framework. Explain that the TCFD fundamentally transformed global understanding of climate-related financial risk by establishing climate change as a material financial and governance issue rather than solely an environmental concern. Discuss the framework's first major legacy, creating a new global standard for transparency. Investors, regulators, corporations, and financial institutions increasingly recognize that climate risks directly affect enterprise value, market stability, operational resilience, and long-term economic performance. Highlight the second legacy, integration into global frameworks. TCFD principles became embedded within ISSB standards, EFRAG regulations, national climate disclosure systems, banking supervision, insurance risk assessment, and investor governance expectations worldwide. Explain that the framework's four foundational pillars, governance, strategy, risk management, and metrics and targets, continue shaping sustainability reporting and corporate governance systems globally. Discuss how TCFD also normalized climate scenario analysis, transition planning, emissions disclosure, and board-level climate oversight within mainstream financial reporting. Highlight that the framework significantly influenced ESG investing, sustainable finance, prudential regulation, enterprise risk management, and long-term strategic planning. Explain that the TCFD created a globally recognized disclosure language connecting climate science with financial analysis and investment decision-making. Emphasize that the framework's influence extends beyond disclosure itself into corporate leadership, financial supervision, capital allocation, and regulatory governance systems. Conclude by explaining that the TCFD's enduring legacy lies in permanently integrating climate-related financial governance into the core architecture of modern global finance and corporate reporting practices. Slide 13. Key takeaways. This concluding slide summarizes the most important lessons and achievements associated with the TCFD framework. Explain that one of the framework's most transformative contributions was establishing that climate-related risks are material financial risks requiring transparent disclosure and strategic management. Discuss the enduring importance of the TCFD's four foundational pillars: governance, strategy, risk management, and metrics and targets. These pillars collectively created a globally recognized framework for integrating climate considerations into mainstream financial reporting and corporate governance systems. Highlight the extraordinary global adoption achieved by the framework. More than 4,000 organizations across over 100 countries, representing approximately $27 trillion in combined market capitalization, publicly supported the TCFD recommendations. Explain that the framework's widespread adoption demonstrated growing institutional recognition that climate governance is essential for long-term financial resilience, investor confidence, and sustainable economic development. Discuss how the IFRS Foundation and ISSB now carry the TCFD's mission forward through internationally standardized sustainability reporting systems integrated with mainstream accounting architecture. Highlight that the framework also transformed investor expectations, regulatory systems, banking supervision, insurance underwriting, ESG investing, and enterprise risk management practices globally. Explain that climate disclosure is no longer viewed as a peripheral sustainability initiative but as a core strategic and financial governance imperative. Conclude by emphasizing that the TCFD fundamentally reshaped the relationship between climate science, financial reporting, investment analysis, and corporate governance. Its principles will continue influencing sustainability leadership, financial transparency, and global reporting systems for decades to come. Here we end this presentation, and the detailed about the topic on TCFD related to climate risk, financial impact and the path to ISSB will be continuing in the coming week. We encourage you to remain actively engaged with our channel, participate in the forthcoming sessions, and thoughtfully disseminate these professional insights across your networks, particularly among business leaders, sustainability practitioners, compliance professionals, and stakeholders committed to advancing responsible corporate governance and transparent reporting practices. The transition toward integrated sustainability reporting is no longer merely a regulatory expectation. It is a strategic imperative for building resilient, accountable, and future-ready enterprises. With sincere appreciation for your continued association, we look forward to welcoming you in the next session as we continue this important journey toward strengthened sustainability leadership and reporting excellence.